Afternoon, everybody. Welcome to our webinar focused on professional service firms. My name is Anna Gerald, and I am the tax partner leading the professional services tax team in the UK. For those who don't know BDO, we're a large accounting network with over $9 billion US of revenue, operating out of 167 countries around the world with over 80,000 people and growing rapidly every single year. Today, our speakers are Jenny Schutt, Jason Land, and Martin Callahan, all the directors in our office and our team, and specialists in their fields, looking at a range of different issues that are really relevant in today's age, albeit a very strange age that we currently find ourselves in. So today we'll be focusing on three different areas. Cash continues to be really critical in these times, and Jenny will be looking at lockup and cash flow management. People also are being pulled around all over the place right now. Demands on their time for various ad hoc, very short notice issues come up. And the demand for efficiency and information is on the rise, as it was prior to C19, but ever more so right now. Jason will be talking about tax technology and the role that it can play in supporting us through these chat times and going forward. And then Martin will be looking at the corporate criminal offence, which of course has been with us for a number of years now, but he will be reminding us what that looks like and also how it's developed since its introduction, but also how we can manage our obligations under that. As always, for those that join us on a regular basis for our webinar series, you can ask questions as the webinar is going on. That is through the Q&A feature at the bottom of the middle of the screen. We'll address any questions at the end of the webinar if we have time, otherwise after the webinar. And as always, we're recording this webinar and we'll send it along with the slide deck in due course. We're always keen to make sure that we finish within the hour, and we'll do so here. And so to kick us off, I will hand us over to Jenny. Jenny, over to you.
Thanks, Anna. Good morning, everybody. My name is Jenny Schutt. I am a director and lead BDO's working capital advisory practice. And today I'd like to share with you some thoughts on the importance of cash and working capital management within every organisation's strategic framework, as well as provide some practical considerations to support the resilience and redefinition of working capital management within your organisations within the new normal. So before I start, I'd just like to bring your attention to some recent research that we've done as a firm in collaboration with census-wide research agency. So each month we survey around 500 business leaders in the mid-market to better understand current issues that they're facing. A couple of headlines from August publication: 87% of UK mid-sized businesses will struggle to trade with current funding arrangements. And UK mid-sized businesses have each taken an average of £21 million in loans as a direct result of COVID-19, with 10% not expecting to be able to pay the full amount back. So we can see within ecosystems, whether it's your organisations themselves, whether it's your customers, your clients, or your suppliers, there's going to be a continued pressure on cash and funding requirements over the course of the coming months. Additionally to that, 91% of businesses made staff redundant due to COVID-19, so again, increased pressures and uncertain times. There were actually some positive notes, which is great. So a third of businesses reported that they've been unaffected or they've actually increased revenue in recent months, and over a quarter, so 26%, have launched new products and services. So again, that's positive news. But we continue to live in uncertain times. I think there's been lots of subsidies and government intervention, which has been great, but as that dries up, there's going to be a continued focus on cash and optimisation of working capital. So recognising this is a lot of tax advisors and tax specialists on this webinar, and you'll be aware of levers that can be pulled there to support cash flows in the short and medium term. There are also systemic working capital levers which can be pulled to optimise balance sheet positions in a tactical and also in a more sustainable manner. And the ability to identify these will be fundamental in the differentiator for your organisations within the recovery phase. So firstly, So working capital management and its effective working capital management. So often within professional services, we refer to working capital as lockup. So it's in essence the time it takes for companies to be paid for the services that they provided to clients and customers. And we typically measure lockup in a number of days. So I like to try and equate this to cash. So a really simple example, if we've got an organisation that generates £365 million of cash annually, 1 day of lockup is worth £1 million. And we've done some recent analysis on the top 50 law firms who reported an average of 145 days of lockup cycle. So from when they start providing the services to when they actually receive the cash from their clients, it takes on average 145 days in that top 50. So if you look at your organisation and you're reporting 165, as an example, as a 20-day delta, if 1 day of cash is worth £1 million, that's an opportunity to improve your balance sheet position by £20 million of cash. And it's really to do with the processes that sit behind. And what I'd like to do is walk you through some of those processes in a little bit more detail, because it's not rocket science to improve your working capital cycles and lockup management. But the problem is, or the issue is, that it's impacted by lots of people across your organisations. And whilst the onus and responsibility usually sits with the CFO or the finance director, a lot of people are impacting that number. So it's important that everybody is aware of how they impact working capital and lockup. If we move now on to the next slide, just bear with me one moment. If we take a step back and think of historical signs of poor lockup management, increasing levels of debt within the firm is a common one. So the inability to fund operations, so needing to look for external sources of finance. Frustrations with the finance team, so whether that be internal finance teams or fully outsourced functions, the relationship that the finance team have with the business and their ability to accurately bill and collect cash. I think one of the main things for me is around systems and the way the systems set up to facilitate accurate billing and timely collections. I think we also see lots of time being spent either by partners or by the finance functions on billing and collections management is a telltale sign that something in the process fundamentally is flawed. E-billing platforms, I've had clients that have had tens, if not hundreds, of different e-billing platforms for clients. So understanding what those individual client requirements are. A culture of month-end billing, that's also a typical lever that we see. So lots of people are concentrating on delivering services and to their clients and quality, etc. And finance is really a second or latter consideration. So the culture of month-end billing, and of course, if 1 day of cash is worth £1 million to the firm, then potentially if you're waiting 28, 29 days before bills are being raised, you're building a lot into your lockup cycle. So all of these issues will have remained. They've probably been further exacerbated by COVID, so working from home, manual, approval requirements, reduced teams potentially if your finance teams and other support functions have been furloughed. So if your lockup performance was poor before, it potentially could be even worse. And it's really a good time and presents an opportunity to wipe the slate clean and just look at what those processes are and make sure they're fit for purpose going forward. If I go down to the next slide. So this is quite an interesting way to look at the lockup cycle and how you can improve cash management. So we start with contracting. So contracting is very much around the billing frequencies that are agreed with your clients and also the credit terms. So do you have in your standard terms and conditions that you reserve the right to raise a monthly bill? There's typically within transactions environment where it's normal to bill on completion. Is it possible to build into your standard terms and conditions that you're able to bill up to a percentage of the bulk fee on a monthly basis as a consideration to say the transaction goes on hold, you reserve the right after a certain period to raise a bill. So there's all these different considerations. Now, it's the most difficult area to impact because a lot of it is market norm driven. If you've got panel agreements that stipulate what billing frequencies are going to be, you wouldn't necessarily jeopardize, being on a panel agreement. But I guess the idea is to have those considerations to make sure that when you are negotiating contracts, that it's being considered and the impact of cash on those decisions are also being considered. Also within the contracting phase, you've got the credit terms, so the credit terms that are agreed that are going to impact your collections management, and also making sure that your client setup is right, so making sure that through the KYC, once KYC has been approved, that your billing entity is correct, your invoicing entity is correct, and your invoicing address, etc., to make sure that the invoice is going to the right location and it's not going to be returned, to be rejected, to be credited, to be reissued. So there's lots of things in that contracting and client setup phase which will impact the overall lockup cycle. Then we move to service delivery. So this is very much your teams being aware of when bills can be raised. Also often see here that the scope creep, so you agree a scope within the initial piece of work with the client, and then over the course of the delivery, scope changes. So it's making sure you're having discussions with the client to agree what the fee impact is going to be, so it's not a case of getting to the end of the service and having to have that conversation, and that's taking 2 to 3 weeks to agree, and therefore it doesn't enable you to bill for that service that's being provided. And then we move on to the billing period. So once the service is completed, how long is it taking you to get the bill out the door? I very much here see that it can take, up to 28 days for those bills to be raised. Again, if you're in a transaction, a real estate environment, you really need to be billing as soon as possible to make sure that your cash is going to be collected within the fund flow. But again, recognizing that client delivery is going to be forefront of people's minds. So it's very common for people to book, 5 hours out of their calendar at the end of the month and raise all the bills. If we can be constantly billing throughout the month, it has a massive impact on your cash position. And then finally, for collections management, so everything here is built on what's happened further down the process. But what I would say, some firms empower their credit control teams to manage this. Some firms, like the delivery teams, to be supporting it and be used as a first point of contact rather than an escalation. But collections really does need to be looked at in terms of prioritization of value of the collection and also payment performance. So if I know my client's going to pay 3 days after the due date, I won't necessarily chase the client. But if I know historically it's 14 to 21 days late, am I able to, allow the credit control team to put in a proactive call to check that the client received the invoice, it's been approved for payment, and it's within the system for payment. So it just does really support, putting a strategic framework around collections management, support cash flow forecasting, those promise to pay dates and understanding when your cash should be coming in, and obviously can support with identifying potential aged or bad debt to reduce and mitigate some of that risk as well. So at BDO, we look at this very much. I think Anna presented the Rethink model in a previous webinar, but for those of you that are not aware, we look at this in terms of rethink, and this is very, very key for working capital management. So React is a phase, and it's all about risk mitigation. So a lot of companies are already through this. It was the beginning of the downturn and how initial risks were assessed. What we're seeing now is many more firms are in the resilience phase. So running your firm through lockdown, running your firm through working from home with reduced demands. What does this mean for your operations and your cash flow and how that can be optimized? Right through to realize, so a new norm of growth is established within the firm, and how can we optimize processes to make sure we're at a competitive advantage and that we have as much cash generated internally from optimization of processes as we can to support funding requirements and reduce the need for external funding requirements. So when we think about rethink and the realize phase, what I would say, so BDO, professional services firm, we very much, in line with this, but cash really needs to be a top priority, which it ought to be in the current climate, from a board level and management level, a senior leadership team level, and those messages should be cascaded down. As I mentioned, from that service delivery and contracting phase right through to cash collection, there are a lot of stakeholders in the process that impact the lockup position. So you need to have that messaging top down to filtrate through the organisation and make sure people are aware of the importance of it. So what is the message that the board and the senior leadership team are setting? Do my workforce understand the importance of cash management and what the impact of my actions might have on the firm's overall position? Who is ultimately accountable for working capital, lockup, cash management? Is it the partnership? Is it the CFO? Can some of those goals and targets be cascaded to teams that impact the position? Is there an opportunity to rethink the operating model? So if you finance teams, if you've got revenue controllers, credit controllers, finance business partners, is that working well in collaboration with operations and delivery teams to make sure that these processes are optimized? Is there an opportunity to look at technology and the leveraging of technology through driving efficiencies through automation? Have roles and responsibilities been well defined? But I think for me, it comes back every time to the embedding of a cash culture within the organisation. So do we have the metrics in place, to be able to calculate what the lockup performance is and understand how much cash is tied up in lockup, but also do we have incentivization? So are our teams incentivized to be making sure that bills are raised effectively and cash is collected efficiently to support their overall lockup and cash position? So I think, going forward, it's a really good opportunity to look at the processes that drive the cash position and also get the messaging from the senior leadership team around the importance of it and how each individual impacts it, and making sure that the metrics are in place to track and monitor progress going forward and see what the impact is on your overall balance sheet.
Yeah, and Jen, just in relation to the sort of way it all sort of fits together, and I think some firms are definitely focused on that long-term nature of that. Let's get the processes right. Let's try and make sure that every step along the way, from doing the work to collecting the cash, sort of in place, so that there's no barriers. And the tax team is obviously quite key in that, with things like people coming back and saying, there's withholding tax issues, or there's VAT problems, or tax often gets involved in it all the way along the line. And I guess the rethink model is really trying to say, look, we've got the short-term aspects of collecting the cash now, crisis management, make sure that we're collecting the money in. You've got making sure that the processes are right, so the sort of the resilience part of the rethink aspect, timing-wise, which is the next phase. But we are seeing firms putting in place now the changes so that it actually embeds the culture and cultural change the aspect.
Exactly.
Yeah.
So in the rethink, it was very much around the accuracy of short-term cash flow forecasts, looking at collections, looking at potential AR exposure that you've got for bad debt. I think in resilience, there's been a lot of communications with clients and even suppliers when looking at the overall working capital level. But going forward, it's very much that process definition and embedding of the cash culture. Yeah.
Okay, brilliant. Jenny, thank you so much. And actually, some of the things that you touched on there to do with tax technology is obviously really relevant for Jason's bit, so it's a nice segue. So Jason, over to you.
Thank you.
Hello, good morning. So I'm Jason Land. I'm a director in London Tax Group. I focus across sort of two areas really. It's around the way organisations operationalise tax within their business models. So I've been doing this for about 12 years now, and I look very much at the way that organisations undertake their processes for tax, and then also how technology can support that. So this morning I'm here to talk to you about tax technology, so I believe I have the ball, so to speak, so I can, I'm going the wrong way. Sorry about this is me. So I'm going to talk to you about tax technology. I'm going to start by looking back about 10 years to another big crisis that we had, and talk about how some of the businesses, or some of the banks actually, responded to the challenges that they faced at the particular time, because I think there's a bearing on where we are now and what we're seeing around tax technology. Obviously, we've seen a huge amount of innovation and advances in technology, and price points have come down, etc., etc. And there's a real drive from HMRC and other tax authorities around the world to sort of push us to be more digitally connected and submit in a more efficient way. I quite liked Jenny's last slide, which she was talking about how is lockup management built into the firm strategy, talking about processes, and then, as Jenny said, or as Anna said, talking about leveraging technology and driving efficiency through automation, because that realistically is what technology is all about tax technology is all about. So I want to start here really to talk about the financial crisis that happened about 12 years ago now. Now that had a huge impact on the way that the banking sector operated and how the world saw those banks. They had a significant amount of work to do to regain society's trust and to repay the loans from governments. What you might not have been aware of as part of this is the impact it had on their use of technology and their use of technology for tax. 2009 was probably my busiest year in the tax technology field. Some of the really large programs were put on hold or cancelled because of the financial crisis, but we'd never been so busy with small, simple automation to reduce those costs. And really, it was about cost reduction. It was about doing things more efficiently and freeing up time. It was about being more accurate, more efficient, delivering at less cost, and in an environment of increased regulations. You know, the banks had a lot more regulation put on the market. They all had to effectively cover their own costs and deliver sort of business critical outputs. And that really, for the banking sector, that set a benchmark, and that benchmark's still with us today. Now we move forward. So over 10 years from the financial crisis, we've seen massive advances in technology which allow better and more cost-effective access to this quality data, which is what I was talking about there at the start. Technologies that were previously cost-prohibitive are now accessible. And in a post-COVID-19 world, we expect governments will need to recover a lot of the funding that they've given out to support businesses. So those bailout loans, all that financing they've given out. Now, what do we think that's going to mean? Do we think that's going to mean more regulation? Well, possibly. But will HMRC be under pressure to restock the public coffers? Well, yeah, definitely that will be the case. And that sits across two particular areas. That sits across poor controls in businesses and also tax fraud. Now, Martin's going to talk to you. There's a little early segue into Martin's segment there to talk about the tax fraud piece, but it's the poor controls and doing things more effectively and more accurately that I want to focus on here as part of this. Because I think that's the main drive of why MTD is being pushed quite so hard. You know, the tax gap in 2018, 2019 was £31 billion. Sounds like a lot of money. It's actually just under 5% of the total tax that HMRC expects people to be paying across. But a lot of that, significant element of that, is actually linked to having bad processes or bad controls and that sort of reasonable procedures that they're put in place. So we've got businesses and organisations and professional services firms that need to pay back some loans. They may have less staff focused on delivering these sorts of things. There'll be cost cutting and remote working. You know, if we look back 5 years, if COVID had hit us 5, 6, 7 years ago, we wouldn't have all been sitting here on Teams calls. We'd have been struggling a little bit to focus. But technology is advanced, systems are interconnected, and there's less silo thinking about your tax technology strategy. And it's not the first time I'm going to mention tax technology strategy, because I think that's a key, really, for getting this right going forward. Technology can combine and blend data sources. It can test against various parameters, and it can present that value-add information in the form of dashboards or automated reports. And this speed of change, this speed of enhancement is unlikely to slow. We've seen increased regulations from making tax digital for VAT. We've got the upcoming changes around MTD for income tax that's going to hit. And there's shortly going to be a consultative document around MTD for corporate tax. Things need to be more interconnected, more digitally linked. There are, and they're going to continue to be, broader changes in the way that businesses deliver on their tax obligations. Now, whilst remaining compliant has to be at the very top of the agenda, there is a need for businesses really to understand the options and the different solutions available to them and invest wisely to ensure that every pound spent adds to their capability. You know, I've seen examples where organisations have invested here and invested there, and actually they're not connected and they don't talk to each other, and that is not a good situation to be in. So I put up a slide here about the sort of sourcing options around how you might manage your tax compliance. Now, 2009 taught us that finding the right operating model was key. There are always going to be elements that can be done better in-house and more cost effectively if the technology is right. And your business may well be looking at cutting costs, or back office tax and finance functions will be looked at as part of that. But a key area to consider here is around your tax compliance sourcing model. Now, often in our conversations with clients who have got this co-sourcing or outsourcing, or even when they're in-house, they've lifted and shifted what they've done previously, not working through how technology can help them do things better or drive down the cost of compliance. If you outsource a badly managed function, it's managed exactly the same way by your outsourced provider, then it'll be a badly managed outsourced service. And if you do decide to take that back in, you'll be taking back in a badly managed outsourced service. Now, we help clients to focus on the way that they deliver on these services. A better technology approach can give you the flexibility to move up and down this continuum that I put up. In these sorts of scenarios, data models can look something like this. And I think we'll all agree that that you can't really see a tax technology strategy in here. This is really playing sort of whack-a-mole to stay on top of things. You know, reanalyzing, reusing data, but not reusing the transformed data. It's about going back to source. It's just, it has inefficiencies built in within it. Now, typically, we're helping clients to drive efficiency around the extraction and the manipulation of their data, either as part of this insourcing model or as an element of their outsourcing model. And outsourcing doesn't mean outsourcing forever or outsourcing with no aim. Actually, what we often do is outsource, transform, and transfer back a process to a business in, say, 3 years' time. That way, they take back in something that's much more efficient, much more easy to manage. And we use better technology for extraction, analysis, and provide analytics over that data.
Yeah, and Jason, just in relation to making tax digital, do you think that's really going to drive the changes around the data extraction for these purposes? Because there's going to be a demand, not just from within the business, but from HMRC about data and perhaps a constant stream of requirements around data?
Yeah, thanks, Anna. I think you're absolutely right. I think there is, and we're already seeing as of an increased drive. HMRC put back the digital link requirement of MTD for VAT a few months, or about a year, and we're currently going through quite a lot of projects with clients to say, well, how do I get this digital connection? How do I make this data flow through? What is my data extraction and my data analysis process? So absolutely, it's part of the next stage of MTD for VAT, having that interconnectivity and building better data models. It's going to become more complicated when the income tax and the corporation tax pieces come on, because you don't want to be extracting that data again for a different purpose and reworking it. So all of these things are going to be linked in, and they're all going to be quarterly reporting. You know, your corporate tax return will no longer be an annual return. Your income tax returns will no longer be annual returns. They're all going to be quarterly. They're all going to need to be joined up and delivered much more swiftly.
Yeah.
Oops, I may have gone the wrong way. Hang on a second. There we go. So in joining the team, I joined one of my colleagues, came from a large bank, and he did quite a lot around the areas that I work in within that bank. So I thought it was useful just to draw out a case study of actually what we saw. So this is a real life example of the amount of time spent by a tax team within a bank well, on the left hand side about 10 years ago, and on the right hand side about 7 years ago. And what the key thing that I want to draw out from this is the amount of time they spend around the reporting side of things. But this can be linked across any particular process that's time consuming within an organisation. Now, they spent 56% of their time focusing on their reporting for tax at the start of this, and it was just seen as inefficient. You know, they're reporting quarterly. And spending so much of the tax team's time around that data manipulation, extraction, data manipulation, preparation of those reporting numbers meant that I had much less time to spend elsewhere within the business, focusing around their tax compliance, focusing around closing in tax authority audits, etc. And by changing things up, they managed to reduce that time down to 23%, and that was achieved through the implementation of process and technology change. In addition to this, they actually moved from a quarterly to a monthly close cycle, and everything was just much more efficient. They managed to close their tax compliance year ends much more swiftly, and actually reduce the number of outstanding compliance inquiries with the tax authorities. And actually, if we look at the amount of time they spent, they could actually go home on time. You know, that red line there is the full-time employee timing. And actually, during those quarterly close cycles, they were spending 150% of their time in the office, and nobody wants to do that. So increasing complexity in tax technical areas and potential headcount pressure driven by the current environment means that professionals need to be focusing on the tax technical pieces rather than managing the churn of data. There's a real need for improved speed and performance to stay compliant and a drive for more transparency and comparability in what we do. MTD will be pushing everyone to report more quickly in a more joined up manner. And of course, there are more requirements and more data points to consider. The world is becoming increasingly complex. So there's a lot to think about. How do I manage my data better for multiple purposes? What should my insourcing, outsourcing strategy be? What can I do that means I can leverage what the finance team are doing? Well, this is a challenge, and as I said at the start, playing that whack-a-mole to stay on top of things inevitably leads to a tax function that's reactive rather than proactive. And a reactive tax function tends to waste investment opportunities by implementing these point solutions, whereas a proactive tax function will think holistically about that tax technology strategy to ensure that every investment is towards a common goal. And we've seen a real uptick in the last few years of businesses looking to focus on their tax technology strategy. The advantages can be really significant, and it shouldn't be looked at in isolation, actually. Looking at what your finance technology strategy is, looking at how your business is going to be operating and what those key data points are going to be and what your future obligations are going to be key, I think. But what sits underneath this? So having a tax technology strategy is really important, and we're working with clients to help them deliver those. But actually what sits underneath that is either utilising your existing systems better, implementing these third-party solutions, some of which will be familiar to you, but actually there's a lot of new entrants driven by changes in the market in terms of what your obligations are going to be. You know, we wouldn't have heard of ARC Solutions or Vena a few years ago. And then we've got this third box, this innovative tech that I'll come and talk about. Now, we help clients look at each of these and work through what the right solution is for them. And we do this. We've got this innovative tech lab, technology lab, where we sit down with the clients and look at their particular problem or their particular headache, and we help them drive through, think through what their key data points are. We select a number of technologies that will help them enhance that, and we get hands-on with the technologies in a technology lab to help them see how those things could help them do things better. That's really valued by clients. And then there's this bottom box, this innovation and tech box. And in here, we find simple, quick solutions that reduce manual data manipulation, just make things easier. They aren't specific tax solutions. Actually, they're used broadly within finance functions. So quite often you find that these things have already got licenses for within the business, and it's just leveraging those to do things better. You know, and you can use those to really drive improvements around RPA and AI. And we're not really talking about taking people away. We're not going to be replaced by robots. You know, it's about task augmentation and not person augmentation. A manual task we spend time on can be removed with text, be it simple cleanup exercises like the VAT report from SAP. You know, many of us would have taken that report and spent 20 minutes changing its format. With simple modern RPA tools, it can be done in a few seconds at a really small initial cost. Now, is it worth it? In isolation, possibly, possibly not. But when you wrap up all those 20 minutes a week, savings can really quickly add up. The next generation doesn't want to do tax the way we did it. There has to be a better way, right? There has to be a better way of leveraging these things. So finally, I just wanted to highlight the fact that we're in a different place now to where we were 5 years ago. You know, the landscape has changed, not just because of COVID, but because this drive to be digitally linked, the advances in technology, etc. Over the next 5 years, there'll be further legislative obligations driving this requirement to be digitally connected, and we'll continue to see emerging technologies, data extraction, manipulation, visualization. They're all going to be big, and organisations and your firms will need to embrace this in order not just to remain compliant, but need to have a strategy to do that in a way that's joined up and efficient. Otherwise, you know, you'll struggle. You'll be that reactive tax function that doesn't do that particularly well. So, you know, we're encouraging, we're talking to clients about doing this and encourage them to come and talk to us about their pain points around what their technology strategy needs to be and where they need to go with this.
Yeah, thanks, Jason. And I think, you know, what the world is doing is becoming more and more complex. We've got either the same amount of resource or less resource to deal with it, but we still want to think. You know, it's actually taking away the things that we are actually not adding that much value in doing, but we need to do to enable us to really use the information that we've got to think and then drive the positive change rather than just trying to keep up with what we have to do. So I think there's loads of different opportunities. And of course, as you said, and I've seen this, that there's different ways of sort of skinning a cat, if you don't mind the analogy. You know, what's right for one team is different to another. And as you say, driving a strategy around this rather than, big bang change is the way to think about it. You know, how does it fit into everything else we're trying to deal with within the organisation or the tax team, etc. So, yeah, really, really interesting. It's like any change, isn't it? But you know, now is actually quite a good time to think about it because we're under so much requirement to change lots of other things that trying to assist that with perhaps some quite easy changes at the beginning can really make a difference. Which again, as you said, leads us really nicely into Martin's bit around the corporate criminal offence because those regulatory requirements are not going away. And so I'll hand over to Martin to pick up on his aspects around the corporate criminal offence. But thanks, Jason.
Great. Many thanks, Anna. Hi, Martin Callaghan. I'm a director in the tax risk management team at BDO. No video of me, I'm afraid. It's like a webcam issue. But I can assure you that is no loss Anyway, I'll carry on. Right, so we're now approaching the 3rd anniversary of the introduction of the CCO legislation. I can't actually quite believe that the last 3 years has gone by that quickly, but we're now living through what we'd all agree are pretty unusual times. So we have this pandemic giving rise to huge social and financial costs. Obviously, we don't quite know yet where it's actually going to lead to. We don't quite know what the final bill is going to be. And unfortunately, during the pandemic period, there's also undoubtedly an increased risk of fraud, because there are pressures on businesses to cut or reduce costs. And there's an unprecedented move towards remote working, which brings with it a potential reduction in the oversight of employee activity. And HMRC are very, very aware of this. So, for example, at the moment, they're investigating apparently 7,000 instances of potential job retention scheme fraud. And they're all focused, as ever, on the clampdown on tax evasion. And so, in reality, the CCO legislation is as relevant now as it has ever been, if not more so. And I'm sure many of you online will be familiar with the CCO. As I said, it's been with us for 3 years, but just a very quick overview. So under the CCO legislation, businesses can be prosecuted for a criminal offence if they fail to prevent an associated person from facilitating tax evasion. And it's a key point here that the criminal offence is purely the failure to prevent someone else's criminality. And the legislation is incredibly broad, and there are 2 offences, one which applies where UK tax is evaded and one where foreign tax is evaded. And if we were having a longer conversation, we could discuss, why exactly it would be that the UK government is so concerned about foreign tax fraud. But the reality is there are these 2 offences within the CCO, and you do need to be aware of situations where foreign tax also may be at risk. Actually, the legislation's fairly simple. Perhaps that's why I like it. It's pretty simple, works for me. And there are 3 stages to both of these offences. So stage 1, someone somewhere needs to deliberately evade tax, and it can be any tax. It could be direct tax, indirect, personal, corporate, doesn't matter. But the important point is it does need to be tax fraud. So this isn't about grey areas. It's not about getting a detailed technical discussion going. It's about, it's not about avoidance arrangements. It's about fraudulent behaviours which are inherently dishonest. So the point with this legislation is you don't need to be a tax expert to potentially spot a situation where tax fraud is taking place, because in reality it will be an issue where it's an arrangement that commercially just doesn't make sense, and anyone within a business can be made aware of those instances. So you've got stage 1, tax fraud. Stage 2, you need an associated person of a corporate to have deliberately and dishonestly have facilitated that tax fraud. Now that facilitation, it could be through active collusion, but vitally, the definition of deliberate facilitation includes instances where people see something that commercially doesn't make sense, but they decide to turn a blind eye. And from HMRC's perspective, that turning a blind eye, or willful blindness, as they refer to it in the guidance, would be considered to be the deliberate and dishonest facilitation of tax evasion. And if you have those 2 stages, stage 1, fraud, stage 2, deliberate facilitation, the corporate is strictly liable for having failed to prevent it from happening. Now, certainly from a professional services firm perspective, one thing that you also need to be aware of is you're potentially within the scope of this legislation where it's an associated person who facilitates the tax evasion. And the definition of associated person is also very, very broad. It applies to employees and contractors of a business. But businesses can also be held liable for the actions of third parties, for example, service providers, intermediaries, or other suppliers to the business. And importantly, if the facts are right, this can extend to instances where a firm refers a client to another business and that other business facilitates tax fraud. In that instance, that party to whom you've referred the client could potentially be your associated person, and their actions could potentially bring you within the scope of a prosecution. And what happens if it all goes wrong? Well, the downside of the legislation is potentially huge. The corporate is prosecuted, and a successful prosecution would lead to an unlimited financial penalty, regulatory sanction, and significant reputational damage. So, how do we protect your business? How do you protect your business? There is this defence in place of having reasonable prevention procedures. But, what does that actually mean in practice? Well, there haven't actually been any prosecutions to date, so there's no legal precedent that we can rely on. But more on that shortly. However, the defence is based upon these reasonable prevention procedures are based upon having 6 guiding principles in place. 1, carrying out a CCO-specific risk assessment. 2, top-level commitment. So you need senior people within the business to be involved in the risk assessment, to put out some form of CCO policy and communicate to others within the business. Due diligence. So for professional services firms, due diligence on clients is key. It's very common. Know your clients, anti-money laundering. But this is taking it a step further and making sure that you're carrying out due diligence on those persons who could fall within the definition of associated person. And there's lots of very good guidance out there on what due diligence should look like, ranging from HMRC to UK Finance, and also the Law Society has put out some very good sector-specific guidance on this. Proportionality, what does that mean? Well, this all comes down to the size and complexity of the business. So the steps that you take to comply with the legislation need to be proportionate to the size and complexity of your business. And this is key. This is particularly important for those businesses within what HMRC consider to be higher risk sectors. So, for example, legal firms, tax and accounting firms, and those providing financial services. All of your prevention policies and procedures must be communicated, embedded, and understood throughout the firm through internal and external communication, and that includes training. So, for example, we have rolled out CCO e-learning training to many of our clients to raise that level of awareness within their businesses as to what the CCO is all about. And finally, and I think this is a key point for now, because many organisations over the last few years will have taken steps to comply with the legislation. But the point is that initial step can't just be a static or one-off event. So the risk assessment needs to be a live document, and it needs to be linked to whistleblowing and escalation processes. If someone escalates a particular scenario within the organisation, that must then be picked up on the next iteration of your CCO risk assessment. And importantly, you have to take into account new potential risks, such as those arising from the pandemic. So even where businesses have taken steps, they have to make sure that these are refreshed on a periodic basis. Now, one conversation we have fairly regularly with other firms is that, is this point about, well, actually many professional services businesses are very well regulated. And of course they are. And as a consequence, they're likely to have controls and processes in place which will mitigate the risk of tax fraud related to the business. But the important point is, and this is picked up both in the revenue guidance and also in sector-specific guidance, is it's not enough simply to assume that your controls are sufficient to prevent the facilitation of tax evasion. You do need to take CCO-specific steps. There needs to be a CCO-specific risk assessment. And this is, if you look at the HMRC guidance on this, there are case studies within that make reference to this point. So that's the overview. And, so I'm sure all of you have a good awareness of this, but what I wanted to bring the legislation to life slightly now by running through a couple of common areas of risk and how these risks can be mitigated. In the first example, Scott is an employee of a consulting firm. He's taken off payroll and instead invoices the business as a contractor. But there were no other changes to the fact pattern. This is being done purely to reduce his tax liability, lower national insurance contributions, and the ability to deduct expenses from his earnings. Well, clearly what I'm not saying is that there's anything inherently wrong with businesses engaging with contractors. But where the relationship is a misrepresentation of the facts and is being done purely to evade a tax liability, then the business could potentially face a prosecution under the CCO. So there need to be robust contractor onboarding controls, including an assessment, for example, of the status of the contractor. And there needs to be training and comms rolled out within the business to make people aware of the potential impact of these sorts of arrangements. And another key point is that when looking at CCO, many businesses only consider what we call the external or supply chain risks. But it's vital the consideration is given to all potential areas of tax fraud related to the business. And we know that contractor status, for example, is a key area of focus for HMRC. We'll move on to the next example. Mr. Smith is a client of a law firm in respect of a personal matter, and he asks for his invoices to be addressed to his business rather than him. And he's recovering the VAT charged through his company and is committing VAT fraud. Now, the partner at the law firm has facilitated this, now either through colluding with Mr. Smith or perhaps potentially more likely turning a blind eye to their suspicions. And as a result of this arrangement, this could put the law firm at risk of a prosecution under the CCO legislation. And from a professional services perspective, if you look at the Law Society guidance again, it includes a number of scenarios of potential instances that may fall within scope of the CCO legislation. So, for example, if a client asks for a change of wording on an invoice, now there could be many reasons for this. Now, it may be because it relates to a confidential matter that is not known about by the client's staff, and that's one thing. However, change an invoice simply because it helps to obtain a tax deduction or it obscures a taxable benefit for someone is an entirely different matter. And there need to be controls in place to pick this up at the billing stage. Now, if there comes in a request to change the entity or person to whom an invoice is being sent, or to change the wording of an invoice, then this does need to be picked up, and questions need to be asked as to, what's the reason for that. So importantly, if the business asks questions and gets a reasonable answer, then that in itself helps to build up the defence, because they've taken reasonable steps. If later it was to transpire that tax fraud was taking place, the organisation would still be able to say, but look, we did everything we reasonably could to make sure that this wasn't an instance of tax fraud. Now, these are just two scenarios we've discussed with many clients during the course of our risk assessment work with them. And the key next stage is, that's the risk assessment. HMRC's guidance also talks about the subsequent rapid implementation of updates to controls. The key point is, if you carry out a risk assessment, you sit down, you identify who your associated persons are, you consider any potential area of risk to the business, and then you spot a gap in any processes, then you need to update those controls within a reasonable time frame and also document the fact that this has been done. So finally, I'm just going to summarise some activity we've seen over recent months, both from HMRC and more broadly in the commercial world. So corporate criminal offences, the first, almost. We have another month to go. 30 September 2017, this piece of legislation took effect. And I have to, at this point, quick apology. This slide is actually slightly out of date, because hot off the press, HMRC have just issued a new press release with regards to corporate criminal offences. And I'll update those figures shortly. But so what this slide shows is that pre-COVID, HMRC already had a number of live criminal investigations in train. And also we had seen a large number of letters sent out by HMRC's fraud investigation services to businesses, effectively saying to them, we're not accusing you of tax fraud here, but what we're saying is there could be tax fraud within your supply chain, one of your suppliers, somebody who provides contractors to you, for example. Now, what you need to be aware of is that if there is tax fraud in your supply chain, we could still prosecute you. So we need to know what steps you're taking to protect your business and protect the revenue from tax fraud. And so they're asking to have meetings with businesses and discuss things like, well, what does your supplier due diligence look like? It's not traditional question you'd expect from HMRC, but we've seen these letters out there. And the press release that has just been issued and there was some commentary from someone called Sam Dean, who's the head of CCO at HMRC, someone that we know quite well. This new press release saying that there are now 10 live investigations and a further 22 opportunities, as they are termed, under review. And specifically, there were 12 investigations related to businesses in the financial services sector. So I have to say, the press release does say no charging decisions have yet been made, but I think from these figures, first prosecution is undoubtedly in the pipeline. And for any business that hasn't taken any steps towards compliance or refreshed those steps in the light of additional risks to the organisation, it'll be difficult for them to prove the defence. But also importantly, a key point here is it's not just about the potential risk of prosecution, which makes CCO relevant. We have also seen an increase in the commercial impact of CCO as follows. So, for example, we've seen increasing reference to the CCO legislation in supplier codes of conduct and contractual terms, even to the extent that we as a firm have been asked to confirm our compliance with the CCO legislation when engaging with clients. And the consideration of CCO risk is absolutely becoming business as usual in the M&A world. So it's being included in deal documentation and forming part of transaction due diligence. And that's a key point there, because it's I think an interesting story that for the first time last week we came across a situation where a purchaser involved in a substantial deal came close to pulling out of the deal, surely because the target company wasn't able to evidence that any steps had been taken towards compliance with the CCO legislation. And for me, that was a real sea change in how seriously people are taking this particular piece of compliance legislation. But anyway, in conclusion, how would I summarise the CCO? Well, the potential downside is huge. It's massive, both the potential risk of prosecution and also the potential for impact on commercial relationships. But it's actually relatively simple to comply with the legislation. So even where the risk of prosecution is considered low, commercially it's becoming increasingly important to be able to evidence compliance. Thank you. I think back to Anna.
Yeah, thank you very much, Martin. And we're at the hour, but I just want to close by saying that obviously the areas that we're focused on today are not necessarily new, but can be quite daunting in terms of really trying to get to a position where we're got best practice, let alone best in class, and making sure we are meeting our obligations, but also not just scraping our obligations, but doing the best of the business that we can. And I guess the one thing I do want to say, and I don't normally use these webinars to push anything that we're necessarily focused on, but clients have come to us and asked us for practical ways of dealing with these things. So they don't all want big, shiny solutions to their issues. Sometimes, and Jason was talking about this, that there are little things that you can do. There are small toolkits that were developed that people can deploy themselves that effectively prevents you having to develop something yourself, either their training programs or toolkits, as I mentioned, to support people through this. So you can make vast improvements in your business and meet the regulatory requirements by taking fairly small steps if you've got the support. So if there is anybody listening that wants to pick up on any of that, then either come through to me or anybody else that's listed in front of you, and we will be able to talk through what we can do to help, because these are times where everybody needs to muck in to get a good solution. And we might be able to point you in the right direction at the very least, or go further than that if needed. So thank you for listening. I will shut the webinar for now, because I did promise that we'll keep it to an hour. If anyone's got any further questions, then please do let us know. Thank you.